The conversations continue here at Davos 2024. Joining me now is Brian Moynihan of Bank of America. Brian, always great to have you back on CNBC-TV18. Thanks very much for your time. What's the expectation here from Davos this year? Geopolitics continues to be the big concern that CEOs are grappling with, and no one quite knows how this playbook is going to play out. So what do you come to Davos with in terms of outlook and in terms of key concerns?
Well, hey, thanks for having me on again. It's always great to talk to you. I think at the end of the day, you've hit it. It's geopolitics. And geopolitics along, obviously, the Hamas attack on Israel, the Ukraine, Russia, none of those situations are solved and they're on people's minds. But on the other hand, a lot of elections going around the world. And while we're not politicians, we as business people have to think about what the ramifications of those elections. And it's going around a lot of countries, including some you're familiar with.
Including the U.S.
Yeah.
So, you know, and we've been talking to business leaders about exactly that. I mean, how are you preparing yourself or gearing up for an eventuality that could potentially see a change as far as the election is concerned?
Well, at our company, we run a company for a long time, and so this happens every 4 years, and our company's been around since 1784, so there's been a lot of U.S. elections since then, and, you know, if the people vote, people get in. We work with all administrations to try to get their policies right for business, right for America, right for the American economy. And so let the political things take place, and then we have to react to it because it's not ours to control. It's American citizens to vote.
Yes, so let's talk about the U.S. economy. And it has been resilient through 2023, perhaps done better than what most people were fearing. How do you look at the prospects of the U.S. economy from here on, given where interest rates are and the possibility of the Fed cutting in 2024?
Well, so if you last year we were here and we were talking about a potential recession, and they kept pushing it out. Now they've taken it off the table. So our team, our research team, basically has a slowdown in growth, a soft landing, 1% growth for the first 3 quarters of 2024. Mm-hmm. But that's down from almost a 5% growth rate in the third quarter of 23. So it's slowing down. When we look at the consumer in the United States, they continue to spend, but the year-over-year growth rate in their activity, the Bank of American consumer spending money in the economy, is 4 to 5% growth over the last year. Earlier in 23, it was almost 10%, so they've slowed down. And 4 or 5% is consistent with a 2% growth, lower inflation economy. So the markers for inflation being under control are there. They've got to be persistent to make sure. The slowdown in the consumer spending helps inflation because demand slows down. But there's still some work to do, and that's why our colleagues think they'll hold interest rates high in the context of since the global financial crisis, not high in the long-term context of the United States. And, you know, they'll have 4 or 5 cuts next year, 4 cuts next year, 4 cuts a year after, and get down to more normalized levels. It'll take a while to wring the inflation out of the system.
So, given the fact that we are expecting interest rates to be higher for longer, what are the medium to long-term implications of that for the U.S. economy, for the global economy?
Well, the U.S. is the largest economy, so when it has impact to the amount of unprecedented fast rise in rates to choke off inflation for the world's biggest economy, that affects other economies and that changes the dynamic. And so that's having impact on government debt financing that's around the world. That's having impacts on the financing cost of companies and financing cost of state and local governments in the U.S. So all that's got to work its way through the system. So what does it do instantaneously? It slows down house buying, slows down car buying. Things are very interest rate driven. And then until you get to people getting used to and the compensation of the wages and stuff catching back up to the interest rate, people pull back. And we're kind of partway through that. We're working through that. So as time goes on, people get used to the rate structure and it will more normalize. But for most of us that are in my age bracket, most of our life was spent with an age, you know, a 3% or more Fed funds rate. This is the unusual time. And so can the economy function? Sure, the U.S. economy functioned for most of its life at higher rate structures. It just takes a while to get used to.
Well, let's talk about emerging markets and let's talk about India in specific. And at this point in time, in comparison to the kind of challenges that the large parts of the world are facing, large economies are facing, India relatively stable and growing. What's the take on India from here on?
Well, we've got a great team under Kaku in the country, and she does a great job for us. And then we've got 25,000 other teammates that work on services on a global basis for the company. So we've been a major supporter of India for years, from the business, 60 years we've been there now. And so it's a great dynamic. It has lots of talent. It has lots of capacity. It has an ability to put that all to work. And the administration for the last many years has been saying, how do we build India, the economy up? And so we have it growing at almost 5.5% to 6% next year, which for the size of the economy it's coming, that's a very strong growth rate. Now they have to watch out for the other things. Oil prices coming up make it more difficult. That's why they're going so, I assume they're going so hard in renewables, because that's energy independence. It's hard for people to sort of translate that renewables are a source of independence from paying the market prices for oil and things. So they're working on a lot of things with growing pains and all that goes on, but at the end of the day, as a place to produce, as a place to do it, when I talk to CEOs around the world, they are all eyes on India, and the investment will keep following if the policies make sure that investment can get the returns and get in and out and things that very liquid economies like Europe and the United States allow to happen.
Of course, one is, of course, foreign direct investment coming into India into areas like manufacturing and so on and so forth. But now with the inclusion in the global bond indices, what could that mean in terms of fund flows into India over the next few years?
Well, whenever you get into index or metric, people have to own it. And that doesn't mean, that's not a value judgment, they have to. And as they do that, that provides more purchase power, and that provides more capacity. So I think, but at the end of the day, your ability to issue bonds or issue debt is always going to be the fiscal sustainability of your economy. And the U.S. has a big debt, and they've got to deal with that, and they're struggling on how to deal with it. But relative to the size of the economy, it's actually not that big a debt. And so you can get glass half full, glass half empty there. But they've got to start to get the budget more in line with the receipts. Other countries are growing fast. That causes them to have to spend a lot on infrastructure. But the key is just to have a good, sound fiscal policy, a good, sound monetary policy, and frankly, a big private sector emerging. And when I talk to the India CEOs and multinationals operating, it's just they're investing, and that's what really drives it.
Do you see a lot of M&A activity of strategics looking at getting into India? Is that likely to be a big theme that plays itself out, given the domestic story at this point in time?
There'll be a lot of looking, but with the stock price in India at an all-time high, that always gets, it always looks good, but then the question is valuation and getting things done. And that's what's going on around the world. The certainty of completing transactions is, in certain economies is tough. The interest rates cause a higher debt carry cost to actually make the purchase price. And then secondly, valuations have got to get more in line, where more fundamental valuations come through, because some industries are valued way higher than a norm, and others, like the financial service industry, I'd say, is valued way less. Until you get them in line, the sellers think they're underpriced, and the buyers think they're overpriced. So it takes a while to settle in. So I think but when you have a run up in stock market index like you've had in India, it's good news, but also it makes it a little harder to buy.
Speaking of a run-up, we've seen a run-up, at least as far as conversation and focus is concerned, on AI. Everyone's talking about the potential of AI, the transformative impact of AI, but I think there's still a distance away from being able to really understand the use cases of it. From the bank's perspective, how are you going about this? What's the AI strategy?
So I think you have to separate a little bit of the generative autonomous AI engines that you might use in the public domain away from using machine learning, artificial intelligence, and on your data and more controls. So we have a product called Erica that consumers can use. 18 million consumers use 170 million times last quarter, just in the last 3 months. And so it's used a lot. It is a natural language processing. You ask it a question, it answers it, but it's our data, our natural language processing. We got Stanford to build it about 10 years ago. It's controlled, so it can run knowing that the answers are going to be as if a human looking at the same policies and manuals and places could do it. So you got to have that. And then we have a tremendous amount of models working. All of us that engage in the markets business have models going all the time, and so there's a lot of machine learning there. So I think the idea of the productivity come out, it's all real. We can see it. We've seen what it can do across our franchise. But bring it to other businesses. So we brought Erica to our institutional business, our global transaction services business. That gives a chance for corporate customers to get the same beneficiary. But you have to be careful. And so that's the dialogue is really around, okay, there's a whole dialogue about the policy questions and stuff, but leaving that just from an implementation, it's about, can I use my data? Will I get the right answer? Will the answer be explainable enough so I can make a life-defining decision for somebody, denying them a loan, approving a loan, and those types of things. And that's where you need to do it. Now we have models for investors that are AI-driven, so to speak, and so it's a very broad topic, but the real hard thing to figure out is what's going to happen with the generative and autonomous engines. The easier thing is, can you apply machine learning and artificial intelligence principles to our work? Absolutely. We've been doing it for years. We've got to keep doing it.
Are you going to be spending significant amounts of your budget on technology going forward?
Well, this year we'll spend $3.8 billion, this year meaning 24, on technology code. And every weekend we do 1 million plus new lines of code go into systems, and we buy systems from third parties, and we use third parties to provide services to us. So we spend a lot on technology. That's a big part of our budget, and it's probably doubled in the last 10 years.
There was uncertainty as far as the Bitcoin story was concerned through 2023, and it looked like perhaps we wouldn't see any forward movement from a regulatory perspective. We've just gotten cleared for the Bitcoin ETF. What do you make of that?
Well, it's an interesting thing, and I think if you, again, it's almost like the AI. If you separate the blockchain and the digital aspects of that, we have high interest in that. We have hundreds of patents on it. We've been working on. We're not so sure what Bitcoin does. We send trillions of dollars out every day electronically. More than 50% of our consumer spending is all digital. And so we're trying to figure out exactly what it does. There's use cases we can see, but it'll play out from an investment class. We very narrowly let people work with customers on their own ask to go into it, but it's still got a lot of things to work through at our company still.
So the one thing that you're going to be most fearful of, and the thing that you're most confident of as we look at 2024?
Well, I'm most fearful of the escalation of tensions in the various theaters around the world, and whether it's the Middle East, whether it's in Ukraine, Russia, whether it's in China and Taiwan and all that. And it's never what people want to happen, is what could happen. So we always are looking at thought processes and understanding the dynamics of certain activities. For example, the shipping lanes being slowed down or have to go. We look at that all the time. But that's what fearful, because those are things that you don't control. And they're hard. And then the rest of it is really just doing a great job with our customers, our clients, and teammates, and society, and our shareholders. We've made $100 billion since the pandemic started after tax in the company the last 4 years. The team's done a great job. And so we fear everything, we worry about everything, but the reality is things outside our control, what we have to pay attention to, because they can reverberate back in the economy and they hit it.
So with the $100 billion, what's the priority going to be for you for the year?
Just more customers and doing more with each customer. It's a pretty straightforward thing.
Brian, always a pleasure. Many thanks for joining us here on CNBC-TV18, and we look forward to seeing you in India as well.
Yes.
With that, it is time for us to take a quick break here on our Davos conversations. We'll be back with more right after this.